Hi, good evening. My name is Daniela Millan, and tonight I'll be speaking about the final report for Balding Sensor Company. Executive Summary. Balding Company specialized in the production of electronic sensors. It was crucial to make strategic decisions regarding sensor positioning during the simulations. Sensors that were optimally positioned to meet the needs of a specific market segment gained higher customer preference, thus resulted to increased sales and greater profitability. Besides, pricing play a key role in registered sales. Different strategies were applied to each segment. Prices were primarily influenced by the demand of the key segments. Traditional segments typically required the lowest prices because lower prices generally translated to higher sales volume. Following these were the low-end, high-end performance and size segments, where sales volume was influenced by product reliability. In the high-end segment, customers associate higher prices with better quality, which helped attract premium buyers. Production decisions involves setting the numbers of units to be manufactured based on the market size, past production levels, and expected growth. Subsequently, we move on to human resources and finance, where budgets were allocated for advertising, product promotion, and operational cost. Financially, we source funds through both long-term and short-term loans. Below is a summary of our performance throughout the simulation. It's also important to highlight the following were the primary market segments: Baker traditional segment, Bid low-end segment, Bid high-end segment, Bold performance segment, and Body size segment. Round 1. In the first round, our stat was generally poor, but we had return on sales (ROS) of 1.2%, asset turnover of 0.78, which is positive, return on asset (ROA) of minus 0.9%, positive leverage of 2.4, return of equity (ROE) of minus 2.2%, emergency loan of $0 because we had enough cash, a good sales volume of 112,578,467. Earnings before interest and taxes EBIT 7,533,281. We made a loss of 1,328,432, had accumulated profit of 2,860,073, selling general and administrative sales ratio of 14.2% and a contribution margin of 29.1%. Summary of the round. With respect to the above tables and graph at the first round, our positioning was alright. However, we did not inject adequate amount of money in promotion and hence ended up having a lot of stocks unsold. Furthermore, the cost of storing stock inventory led to losses at the end of the financial year. Overall, we lost it at the point of allocating inadequate resources for promoting our sensors as compared to the amount that we set aside by competitors. Round 2. In the second round, there was significant decline in all sectors as compared to the first round. We had a decreased return on sales (ROS) of minus 2.0, decreased assets turnover of 0.65, decreased return on asset (ROA) of minus 1.3%, negative leverage of 2.2, decreased return on equity (ROE) of minus 2.9%, emergency loan of $0 even though we did not have enough capital, decreased sale volumes of 104,063,103, decreased earnings before interest and taxes EBIT 6,899,366, decreased cumulative profit of $796,450. An increased loss of $2,063,063.24. Decreased selling, general, and administrative sales ratio of 12.7%, which is obviously bad, and a decreased contribution margin of 27.3%. There was a general decline in round 2, year 2, due extremely high cost of revision of sensor positioning and other administrative costs. Besides, little was spent on sales budget and product promotions, and the inventory at hand also consumed the little profit. In round 3, there was a significant improvement in all sectors as compared to previous round, with exception of contribution margin. We had positive deviation in return on sales (ROS) of minus 1.5%, which is a big improvement. Asset turnover of 0.68, which is a positive and improvement from year 2. Return on asset (ROA) of minus 1.0%. Positive leverage of 2.0, return on equity (ROE) of minus 2.1%, emergency loan of 0, and we had enough cash. Increased sales volume of 105,123,943. Decreased earnings before interest and taxes (EBIT) of 6,675,812. We made a loss of 1,564,557, meaning a lower loss than in round 2, and had increased cumulative profit of 768,107. Increased selling, general, and administrative sales ratio of 13%, which is slightly and better, and contribution margin of 26.8%. Round 3, marketing strategies. There was a significant improvement in this round 3, year 3, due to a decision to project production based on the sales volume and strategies from competitors. This in turn brought improvement and little success in our company. Overall, the business has started doing well. A loss-making business is now turning to a profit-making business. Round 4. In round 4, there were both positive deviation in some sectors and negative deviation in other few sectors as compared to previous round. We had a positive return on sales (ROS) of 1.8%, which is a big improvement. Asset turnover of 0.83, which is positive, an improvement from year 3. Return on asset (ROA) of 1.5%. Positive leverage of 1.8. Positive return on equity (ROE) of 2.7%. Emergency loan of $0 as we had enough cash. A good sales volume of 114,429,117, which also show an improvement. Increased earnings before interest and taxes of 9,796,824. We made increased profit for the first time of 2,084,265, and a great improvement than previous year, and had increased cumulative profit of 1,316,158. Decreased selling, general, and administrative sales ratio of 10.2%, that is good, and a decreased contribution margin of 25.4%. We are really happy because there was a tremendous improvement in this round 4 due to a decision to project production based on the sales volume and strategies from competitors to promote our products well. Set aside good funds for product promotion. This in turn brought improvement and huge success in our company. Overall, the company has started doing well. A loss-making business is now maintaining to a profit-making business. Round 5. In round 5, there were both slight improvement and decline in some sectors as compared to round 4. We had a slight negative return on sales ROS of 1.5%, increased assets turnover of 0.96, a slight decrease in return on asset ROA of 1.4%, decreased leverage of 1.6, decreased return on equity ROE of 2.3%, emergency loan of 0 as we had enough cash, increased goods sales volume of 122,141,331, decreased earning before interest and taxes EBIT of 7,901,595, decreased profit of 1,806,706, and we had a cumulative profit of 3,122,864. Increased sales in general and administrative sales ratio of 11.5% and a decreased contribution margin of 24.2%. As much as the company has lower contribution margin, we did almost everything right to turn around this company. We are delighted that it started making profit and growing in a good trend. There is a positive profit among other things apart from the high interest and tax cost. The company has invested well in research and development and also in sales budget. Round 6. In round 6, there was a great improvement as compared to round 5. We had a positive return on sales ROS of 2.3%, which is an improvement. Assets turnover of 0.98, which is a positive and an improvement from year 5. Return on asset ROA of 2.3%. Positive leverage of 1.6. Positive return on equity ROE of 3.6%. Emergency loan of $0 as we had enough cash. A good sales volume of 128,387,494, which also show an improvement. Increased earning before interest and taxes EBIT of 9,126,472. We made a huge profit of 2,985,396, a great improvement than previous year, and had a cumulative profit of 6,108,260. Decreased selling, general and administrative sales ratio of 9.7%, which means a decline that is good and bad, and contribution margin of 22.7%. Summary of round 6. The widely accepted belief that a struggling company can be turned around with the right approach was proven through our experience, or in this case, my experience. By making strategic and well-informed decisions, I managed to steer the company in the right direction. I am pleased to see that it has begun generating profit and its on promising growth trajectory. Despite high interest and tax expenses, the company is showing positive earnings. Notably, there has been strong investment in research and development as well as in the sales budget. Overall, the company appears set for continued growth, which help offset the previously accumulated losses. Overall conclusions. Looking at the outcome from round 1 through 6, it's clear that the company had a rough start but gradually transformed into a profitable business. In the real world, we often see skilled managers successfully reviving underperforming company, and that's exactly what we experience here. Though we started off poorly, we eventually made sound decisions and achieved a strong finish. I truly enjoyed participation in this simulation. Thank you, Dr. Gonzalez. It's been a pleasure that you were my professor in this journey. Have a great evening.